Comparisons. This one's going to be a little bit of fun. The covered call sample searches. Oh, I'm sorry, this came in from Mike. Mike says, would you discuss what are good proposed strategies that work well using the sample searches for covered calls on the website, specifically the 7-Eleven and dividend searches? All right, well, what are the sample searches? When I go to a strategy, covered call, naked put, you can go into the search tool in PowerOptions. We have default searches there, and you can adjust the criteria. There's another tool called sample searches in every strategy, and this is designed to be themed reports, search criteria that are separate from the defaults in the search tool. What do I mean by themed reports? Where there's a specific idea behind it. The 7-Eleven report is looking at more volatile covered call positions, higher implied volatility, where you're looking for at least a minimum 7% return if assigned, and having a minimum 11% downside protection. Broker and advisor recommended it is using a filter specifically for that low broker rec, going towards more the strong buy recommendation. Dividends and out of the money, dividend paying stocks with out of the money covered calls looking for growth, and dividend and in the money. There's a themed search for under 25, and most of these are just standard monthly expiration filters. These are there to help new investors into options see an idea. I just started trading options or reading about options a month and a half ago. I took a couple videos online. I took a couple of course maybe, or downloaded a couple free white papers or free videos, supplied my email to someone. And I hear people talking about a way to enhance my stock ownership is to rent out my stocks with covered calls. And hey, why not get paid twice? Use a dividend paying stock and sell covered calls against that with the idea to hold it. So how would they even create that search? Well, that's why this theme search is there. So you can use that as a starting point to fine tune it. They're not direct recommendations or suggestions. But that being said, of course, there are so many. But why are there so many? Different themes and different starting points for different investors. The aggressive searches for someone who's more aggressive with covered calls, looking for a higher return and willing to take more risks, would probably be the 7-Eleven report and the under 25 to start with. The under 25 makes sense, doesn't it? The new investor coming in, they only want to allocate $10,000, $12,000 and are only allowed to trade covered calls. So they're going to start off maybe looking for some lower price stocks in the $25, $30 range or so. Sort of a mid-range would be the dividend and out of the money in different market conditions, and the broker recommended. The most conservative, what you'd expect to see was sort of the higher win rate, but a lower potential return would be conservative dividend-paying stocks within the money covered calls and looking at the non-inverse and non-leveraged search for ETFs. So that's originally what my answer was going to be, but that doesn't answer everything. Let's take a look at the quick definitions of each. And so here's the themed report page. When you click on covered call and you click on sample searches, you'll see these listings, and you just click on the link to access the search results. 7-Eleven, as I mentioned, is looking for 7% of side, 11% downside protection. These are slightly in the money, smaller companies, a little more speculative, with good broker ratings. And the IV we're keeping below 1.50, but you're going to see some high volatility stocks in there, 1.2, 1.3, and so forth. Parameter settings are aggressive, especially seeking for higher returns, but you're taking on the risk with the more volatile positions. Works great in some markets, doesn't work as good in others. The broker and advisor recommended list is looking for stocks with that higher recommendation. It was part using also the S&P 5-star list, which is not active anymore. We're not using that anymore. And looking for a good option premium close to $1, downside protection of greater than 3%. Usually these are more at the money positions. ETFs, pretty simple. Looking at covered calls and ETFs. We include the leveraged ETFs. I'm sorry, I forgot to mention that. We include the leveraged ETFs that are somewhat volatile. But it is moving the inverse ETF. We want some protection, so we're going slightly in the money on these positions. Dividends and in the money, well, looking for good dividend-paying stocks. I think a 1.5% dividend or greater, 1 month out covered calls that are in the money to try to enhance the returns. Potentially could be assigned early on a next dividend date, but that's okay because you'd make the max return. Obviously, since you're selling in the money in this case, you're not planning on holding that dividend stock for a longer term. you're looking to be called out at one point or other. You might buy back into it, but again, that's what that one's doing. But if you want to play dividend paying stocks with a covered call strategy, you want to hold the stock longer term, you're probably going to consider using the dividends and out of the money screen. It is looking for a large market cap, looking for stocks, of course, over $5 in price, large cap companies, covered call right of at least 50 cents per contract. So we're not going too far out of the money, and a downside protection about 2.5% or more. And then the 25 report, or these are stocks under $25, typically at the money covered call positions, looking for stocks in an uptrend above the 50-day moving average, looking for a balance of risk and trying to keep a reasonable downside protection of at least 3.5% in that case. All right, well, that's all great and dandy. That's what they are. What do they do? Well, tried to put together a quick afternoon test for Mike. And what we did here is we went from 3 months from August 17th, so starting monthly covered calls on August 20th, and through December 17th, through last standard expiration. We took a $100,000 account, and we're going to allocate 33% to the top 3 trades on each of those searches. Some of them are sorting it by the highest percent if unchanged. Some of the searches are sorting it by the highest percent if assigned. Some of them are sorting it by the highest downside protection. But we're only going to take the top 3 trades and put a whole 1/3 of that $100,000 account into each trade. And we're just going to use standard IBD rules. If the stock, we're going to put a stop in. So if the stock falls 8% from when you open the position, we're going to close out the position and take whatever small loss, or in some cases, a small gain was realized on that trade. And no particular order, just the order that they were shown on that page. Here are your trading results for that 3-month test that finished up. The second highest return was the 7-11 report, 11.4% return. Over the course of 3 months, opening 3 trades, we did have 11 positions. It opened an extra one in some cases there. So we had 11 positions, but 7 wins and 4 losses for a 64% win ratio. The average gain on the winners, 7.9%. Higher volatility, higher premium taken in, higher potential return. And the loss was limited to a reasonable amount of only 3.6%, also due to the higher premium. Remember, these were slightly in the money as well. So you get that little good downside protection. And over 3 months, this turned out to be an 11.4% return on the position. BrokerEC was essentially break even, which was tough to swallow because I had the same win ratio of 64%, which is a little low for covered calls. But yeah, it's essentially break even. Average gain on the winner is 2.9%, more to the conservative side. And average loss on the loser was fourth highest technically at 4.5%. That's what brought the account down, was the higher percent of losers losing average to winning average in those cases. All right, next up, as you can see, the ETF, 1.4% return over 3 months. Conservative, like I said, but it did have a terrible win-loss ratio. And part of that was due to some of those more inverse ETFs, the 2 and 3 times bulls coming up and the things which sometimes had a big loss. Remember, went through September on this. All these tests, for those 3 months, it included that September decline. And that's where most of those losses came in on these ETFs. The average gain to average loss ratio is pretty decent. Average of 3.7 on the winners, minus 1.9% on the losers. If you could turn that around in a good market to make this more of a 60, 65, or 70% win ratio, this would look really strong. Unfortunately, over the last 3 months, it really wasn't, especially with the inverse coming in. Steady as she goes, right? Dividend and in the money. $100,000 account went up to 107,344 for a 7.3% return over the 3-month period. So a little bit more than 2% per month in that case, month by month as well. And 11 wins and 1 loss, 92% win ratio. Fantastic, because we started in the money with dividend-paying stocks, a more conservative approach. Average win 2.5%. That's a good target for a monthly covered call trade. and the one loss was at 4.9%. So it's pretty decent. Third place on our list for ending return. The dividend and out of the money performed the best money-wise. And a lot of that was due to the run-up in the market after the September decline, because you're not getting assigned in the money as you are here and here. If we went through a 2-month decline instead of just a 1-month decline, following September declines, the dividend and OTM did not look so good. The portfolio had bigger losses and drawdowns in it just for that 1 month of trading, because you didn't get as much premium to hedge the declining dividend-paying stocks during that month. Another advantage, though, compared to the under 25, which we'll talk about in a moment, is that the dividend stocks typically have a lower beta. They didn't fall as much as the market did. They fell, but they're still more strong bellwether stocks. So the large growth to capture the intrinsic gain to the short call really bumped this up. But again, it was only a 64% win rate. Average gain 9.3%, again, because you left the upside open and the stock started to move through those. So you got a higher percentage return if assigned, because you're pocketing more of that and you're not taking a more safer gain by being slightly in the money with these others. And the 4 losses were minus 4.4% in that case. The under 25 was disappointing. There's a loss of 2.3% over the last 3 months, only a 45% win ratio. Did show a good return. Third highest return is 6.6% average on the winners, but 5.5% on the losers, which also hurt as well. That tended to be the worst one during the last 3 months. Now, the monthly picks of the day came in essentially 4th place, if you look at it that way. But it was out to a 6.6% return over the 3 months, averaging 2.2% per month. Good success rate of 67%, 9 wins, 3 losses. Why are there more here? Okay, well, that's this one. You said you had 12 here. We have 12 here, but most of these are only 11. I think in September what happened is that when we ran the search to find the top 3 trades, there were only 2 trades at the end of September going into October after the decline that matched these criteria that only have 11 trades. These ones with 12 trades, they still had positions that matched those, all 3 positions, I should say, after the September decline, as did the dividend and in the money. Decent return, 3.9%. Pretty good. It's 3rd place again. Yep, that's 3rd place again for the average return on the winning covered calls for the monthly picks of the day screen versus 4.9% on the 3 losing trades. Even though the stop was set at 8 when the positions fell in that case, you didn't see the full loss. You wouldn't see an 8% loss because you had the money to hedge it and you were slightly in the money to begin with. In fact, on a couple of these positions where stop was hit for that 8% stop loss I mentioned, they were actually small gains of 0.4 or 0.3% due to the premium that was collected. Now, a question might come in and say, well, what happened to the, there it is. No, it's not. It's not done yet. What happened to the weekly picks of the day? Why aren't they included? The reason why is because it's not done yet. It took me from about, Mike, I don't remember when you sent the email. I can't remember if it was 3 or 3:15. I apologize for that. But I started doing all these tests and got them all done right about 4:18, and I started the other one at 4:20, the weekly. But naturally, the weekly is going week by week, so it takes more time. There's probably going to be closer to 40 trades, and so the system's still chugging, and I don't have the end results on that as well. All right, now let's be clear about everything in this case. What we want to be clear about in this case is that past results are no guarantee of future returns. The themed reports are designed, as a stepping stone. They're not direct trade recommendations. We wanted to put this together for Mike so that he could see sort of what he would expect with those positions. And the returns sort of doled out what we'd expect. In a declining market, you're going to get hurt more with that 7-11 report, even with the higher volatility, the higher returns and being slightly in the money. They're more volatile positions, likely with a higher beta. But in a recovering and strong market after the decline, they're going to lead to potentially higher returns, but you've got to be careful. And as always, I recommend you always want to use a stop in that case. 3 months does not the market make, but You can see what SPY did and what the general market did over the last 3 months. See what those returns were there for those themed covered call reports to give you a gauge, maybe what makes you more comfortable for an approach for trading covered call positions. As we all know, options involve risk and may not be suitable for all investors.